It began with hope, the kind that drives revolutions, the promise of technology, the ease of money, the unstoppable rise of startups. In the early 2010s and into the 2020s, the world was riding a high of disruption. Silicon Valley had become the Vatican of innovation. All you needed was an idea, a pitch deck, and suddenly a few $1 million landed in your account. With nothing but buzzwords and ambition. Move fast and break things wasn't just a slogan anymore. It became the financial compass for a generation of founders, venture capitalists, and institutional investors looking to get rich or die trying. What started as genuine innovation quickly spiraled into unchecked speculation. Central banks printed money like it was going out of style. Interest rates plunged to near zero. Governments across the globe injected stimulus into their economies to avoid collapse during the COVID-19 pandemic. That tidal wave of liquidity had to go somewhere. And where it went was startups. Tech companies, many of which had no products, no revenue, and in some cases no customers, began receiving absurd valuations. You had food delivery apps worth $20 billion, 0 cents, while losing money on every single order. You had AI startups claiming to be the next OpenAI or ChatGPT killer before even launching a beta. Founders who had barely built a minimum viable product were suddenly gracing the covers of Forbes and getting showered with hundreds of millions in funding. By 2025, over $7 trillion, 0 cents, had been poured into these ventures, many of them through SPACs, special purpose acquisition companies, which allowed companies to go public without going through the rigorous process of a traditional IPO. SPACs were supposed to democratize access to high-growth companies. Instead, they became the Trojan horse for vaporware. Shell companies filled with promises, not profits. And now, we're staring down a silent monster. This isn't a flashy, dramatic crash like Lehman Brothers in 2008. This is a slow-motion implosion, hiding in plain sight. Behind glossy presentations and slick TED Talks lies a brutal reality. Most of these companies are burning more money than they bring in. Their growth is often just user acquisition paid for with venture capital, not organic traction. Their staff? Bloated. Their runway? Shrinking. What's even more alarming is who is holding the bag. It's not just high-risk investors. It's pension funds, college endowments, retirement plans, and your 401k. Institutions that manage the futures of millions of people have thrown billions into funds backing these overhyped startups. Why? Because chasing returns became a necessity in an environment where savings accounts paid nothing and inflation ate into every dollar. Wall Street knew the risk, but they didn't care. They took their fees, made their exits, and passed the ticking bomb downstream. Retail investors followed, lured in by Reddit threads, TikTok finfluencers, and YouTube channels promising the next 100x unicorn. No one wanted to miss the next Tesla. No one wanted to be the idiot who didn't buy into the AI revolution or the Web3 gold rush. FOMO became the financial strategy of the decade. And now, founders are disappearing, literally. Some have ghosted their own teams, others are quietly exiting the country. Layoffs are sweeping through tech like wildfire. Stock prices for many recently listed companies have cratered by 80–90%. Entire sectors like NFT marketplaces, delivery drones, and fake decentralized finance platforms have collapsed overnight. But the real crash hasn't happened yet, because the true value of these companies hasn't been marked to reality. Here's the nightmare scenario. If just 5% of the $7 trillion, 0 cents, in valuations is corrected, if just a small fraction of these companies are exposed for having little to no value, it would wipe out hundreds of billions from global portfolios. Banks, funds, and insurance companies would start a sell-off. That would trigger panic in adjacent markets, and before you know it, we're not just talking about a tech collapse, we're talking about a systemic economic earthquake. And the media? They're silent. Why? Because the same media companies are invested in these startups. Their parent companies are backed by the same VCs. The influencers you watch online? Many are paid directly or indirectly to promote these stocks, these apps, these shiny new platforms. The narrative is tightly controlled, and retail investors are once again being led to the slaughterhouse. Smiling, the worst part? Most people won't even realize the danger until it's too late. The crash won't look like 2008. It'll look like 1,000 slow leaks happening all at once, quietly destroying savings, investments, and retirement dreams. By the time the headlines finally catch up, the smart money will already be gone. So ask yourself, what are you really invested in? Do you even know? Is your money in something that makes profit, or just headlines? This isn't a warning, this is a reality check. The bubble is here. It's already inflated, and every bubble eventually bursts. If this shook your trust in the financial system, do one thing right now: subscribe, because the next video uncovers the hidden cracks inside the banking sector and how this slow collapse might already be underway. You don't want to be the last one out.